We're going to move on here to a sector that is obviously largely affected by rates. Bank stocks, meanwhile, did hold on to their gains after this Fed decision. And there was also news that the central bank is considering easing capital requirements for big banks next week. So for more on that, let's bring in Chris Marinac. He's of Janney Montgomery Scott. Chris, what do you make, I guess, of what the Fed chair had to say as it pertains to your coverage to the banks? What does it mean now that we know a little bit more, maybe, about what the Fed is thinking today than, say, we did yesterday?
So, Courtney, I think that the higher for longer rate environment benefits the banks. They can have a higher spread. I think that the deposit costs have already come down. If anything, I think the lack of certainty that the Fed has is telling the banks to continue doing what they're doing, which is a very careful lending setup. It's a very slow loan growth. That's the only bad news that we see. Credit costs continue to behave well. I think there's no change. So to some extent, no news is good news for these companies.
What about on this SLR change or potential change? I mean, what does that mean to your coverage universe? Does it free up more capital, and who benefits the most potentially?
It really helps the large 8 G-SIFI banks that are trading treasuries. Yes, they could hold more treasuries down the road, but ultimately I think it facilitates trading and activity to create more liquidity, which is sorely needed. You know, for the last several years, we haven't had the proper trading liquidity in treasuries. It's created these dislocations day to day and week to week when you have volatility. And so the SLR is going to help facilitate that. I think Jamie Dimon covered it well in his April earnings call, that it really helps to trade and helps clients accommodate. It doesn't necessarily mean the bank's going to hold more treasuries. Over time, you may see the banks hold more.
Yeah, Chris, first of all, I share your view. I think this is your view that big banks look pretty good here. I think they do. And I think actually there's a number of forces. But I have to oversimplify this because it's not this simple. Of the three, whether it's investment banking and sales and trading activity or net interest margins or a regulatory tailwind, which of these are the most important for you in terms of your outlook and your ratings and what we should all be looking at here?
Sure. Well, spread is the biggest dollars, Tim. So I think spread is the first. I think investment banking would be next. And I think the trading is right there with investment banking, very much a close third. You know, the reality is the banks still make a lot of money on their regular way deposit and loan taking. And I think that even though we have competition from the outside world in private equity, I think that there still is a fair amount that banks are doing with their balance sheet. And frankly, the low cost of funds has always been the competitive advantage that these banks have.
Chris, understanding that the carry is probably not the best constructed ETF, but what do you make of the underperformance of these small and regional banks compared to the larger banks that you and Tim were talking about?
Sure, Guy. I think it has a lot to do with those medium-sized banks. While they're taking share and making a lot of money, they're just not sexy. They're not growing revenues as fast as other parts of the financial ecosystem. I think it has more to do with the simplicity that investors would rather chase crypto and other areas that are non-regulated. And at some point, we're going to come back to the regulatory side because I think the easier regulatory environment is going to help these banks merge. It's going to help them do better and have less onerous rules and regs that have been constraining them the past 5 years. But it's just going to take time for investors to kind of warm up. And I think a lot of it goes back to loan growth and the fact that it's not that attractive to see these are just slower growth, you know, kind of late stage companies. And they're not as growth oriented as many other parts of the marketplace.
Chris, before we let you go, I was going to ask sort of where you're thinking on bank M&A. You sort of mentioned it there with the possibility of lower regulations now that some of these seats have been filled. Who benefits in your space?
Sure. I think your medium-sized banks who can consolidate and create more 40 and 50 and $60 billion banks is really where the action's going to be. Over the next 2 years, we probably see a few of the large regional banks marry. It'll be interesting to see what Wells Fargo does now that they can take on more assets. I think they will probably be simply putting liquidity to the work for a while. But I think the M&A is going to be much more of a mid-cap and smaller cap arena as you really consolidate that end of the industry. That is going to continue to slowly take hold. We had a deal this week. We have a few that have lined up in the recent months, but it's still not anything seismic like we've seen among big bank to bank. I think a couple of those may take place, but it's probably next year's business.